Hi, I'm Darius Dale, Senior Analyst on the Hedgeye Risk Management Macro team. One of the things I wanted to talk to you today about is potentially warming up to Brazil. I know, Brazil on the long side. So you know we've been very bearish on emerging markets for quite some time now. We saw it as the carry trade it was, and as that carry trade unwound, we were increasingly negative, and Brazil was one of those economies we were very negative on. But right now at this current juncture, we're warming up to Brazil on the long side because we think two things are going to happen domestically here in the United States that could be very positive for Brazilian growth inflation policy fundamentals as well as Brazilian capital markets. So if you look at this first chart here, the red arrow, inflation accelerating in the U.S., we think inflation has the potential to sequentially double from roughly 1% to 2% plus over the intermediate term, and there are a variety of factors that we think that could happen. Number two, that green arrow going down. If you double inflation sequentially in a 75% consumption-based economy, you will have economic growth slow. Mark my words. You could potentially see growth get cut in half from the 3Q13 peak of roughly 4%. So this next chart, dollar down, rates down, EM relief rally, question mark. We show our quantitative levels on the dollar index, and clearly it's in a bearish formation, it's broken quantitatively, and that's signaling to us that the Federal Reserve, or at least the market expects the Federal Reserve at some point in the next 3 to 6 months to get more easy at the margin. Again, obviously tapering's baked into the cake now, but this dollar chart is telling me that they're either going to untaper or issue some kind of very easy forward rate guidance that's a negative for real interest rate expectations in the U.S. So in this next chart, we show the quantitative setup of the 10-year Treasury yield, making lower highs, broken from an intermediate term trend perspective. That's remarkably different than what we saw over the last 3 to 4 quarters of higher highs and higher lows as U.S. growth accelerated. Now the Treasury market is pricing in slowing growth at the margins. So why Brazil? There's 3 reasons really to be bullish on Brazil, and mostly the Brazilian real, and we'd like to play Brazil through Brazilian real and potentially the equity market if the real continues to strengthen. So number one, a widening real interest rate spread. If you look at Brazil, obviously Brazil is a very high yielding emerging market economy, but one of the things that's been happening recently is those yields have gone up dramatically. The Bank of Brazil has hiked rates 350 basis points since in their current tightening cycle rather, and that's starting to sort of weigh on inflation expectations in Brazil at the margins. But at the same time, what's most important, you have falling in real interest rate expectations in the U.S. So that's widening the spread between Brazilian monetary policy and U.S. monetary policy that should be on the margin supportive for capital flows out of the U.S. and into Brazil. Number two, a likely narrowing of the current account deficit. So Brazil's current account deficit, it continues to widen to all-time lows, especially in the post-crisis era. One of the key factors we don't think investors have even done the work on yet is the World Cup. Now, I typically don't anchor on things like the Olympics or World Cup because they're transitory, but when you're thinking about the impact that this could have on Brazil's GIP fundamentals, it's meaningful. So typically what you see in host countries that host the World Cup, they tend to have a roughly 200 basis point acceleration year over year in reported real GDP growth. And they also tend to have a roughly 100 basis point acceleration or sequential rising in the current account balance. So for Brazil, that would represent a move from roughly 3.5% to 2.5% on the current account deficit as a percent of GDP. That's a material delta that we know is not currently being priced into the forwards market, and we think that's something we'd like to take advantage of in the long side. And then number three, it's just undervalued. It's very, very cheap. And I hate saying that word because at Hedgeye we strongly believe that valuation is not a catalyst. You actually need the fundamentals to change and turn. But we're arguing on the margin that these fundamentals are turning, and you have a very undervalued equity market, a very undervalued currency market as well. So if you look at it on a real inflation-adjusted basis, the Brazilian real is undervalued roughly 12 to 15% relative to trend. And if you look at it on an interest rate spreads basis, it's undervalued roughly 20 to 35%. So that's a lot of potential juice to the upside if, and I say if, we get an emerging market relief rally over the intermediate term. And so on this next chart, it looks pretty complicated, but I'll explain it to you. So on the x-axis, we have the real inflation-adjusted 3-month deposit rate, which is essentially just the spread between the 3-month deposit rate and inflation. And on the y-axis, we have the real dividend yield for the equity market there. And what you see here is that, being far to the right there, Brazil is in a position to take advantage of capital flows if, in fact, we start to get an asset price cycle that favors emerging market carry trading strategies. So with that, we just want to wrap that up. We're warming up to Brazil and broadly emerging markets on the long side here as U.S. economic growth expectations fall and expectations for real interest rates in the U.S. fall over the intermediate term. If you have any questions, comments, or concerns, please ping me. I'm at HedgeIDDale on Twitter. Thanks. Have a great day out there.